The latest headlines: UBS has agreed to buy embattled rival Credit Suisse for 3 billion Swiss francs, which is about $3.2 billion. What has happened exactly at Credit Suisse can actually be explained very simply with this share price chart. You realize that since 2007, Credit Suisse has been on a downward trend all these years, and many experts have pointed their fingers towards poor investments and mismanagement of the company itself. Credit Suisse has some bad investments that turned sour, such as their $5.5 billion loan to Archegos, which did leverage trades and stuff and went bust in 2021. In my opinion, the saga at Credit Suisse has dragged on way too long, and finally it came to an end. And in my interpretation, I see it as an isolated event. However, something bigger seems to be brewing in the US banking system. Take a look at this. Moody's has recently cut the outlook for US banking system to negative, citing rapidly deteriorating operating environment. Previously, their outlook was stable. Now, all this has to be attributed to the SVB saga, which is the Silicon Valley Bank, being one of three that has collapsed. So in this video today, we're going to answer whether that is an isolated event, and more importantly, are Singapore banks safe or not? So if you're keen to find out, continue watching on. Hi guys, welcome back. Today, we'll firstly start the discussions looking at the US banking system, which may have problems. And to find a bit deeper, we have to really dig into SVB's saga, because there are clues. They are after all bigger than most regional banks in US, and their symptoms are there for us to investigate a bit further. The story goes like this. SVB actually called for $2.25 billion worth of new capital to cover up for losses. They proposed to sell stock. This move, instead of shoring up confidence, actually felt like a confirmation to all the rumors that were in the market that SVB was insolvent, and that's why a bank run happened. Bank run simply means that everybody goes down to the bank to start withdrawing out money. How much was withdrawn? $42 billion in a single day. That's reported by CNN, and that actually means $29 million every minute. Not many banks, if any, can actually tolerate such a rapid withdrawal from its banking reserves. Do note, after all, that our banking system is a fractional reserve system, which means only a fraction of the bank deposits are kept within the bank for withdrawal, and most of it is actually loaned out. If you're not familiar with the fractional banking system, let me use this diagram to explain things. Take for example, somebody deposits $1,000 with the bank. What the bank does in theory is to reserve $100 for withdrawal and to actually loan out $900. And the person borrowing this $900 may actually redeposit back this money into the bank, and that's where money is actually created. The bank again reserves 10% in this theory, which means $90, and $810 is lent out again. And as you can see, this cycle repeats itself, which means the bank does not have as much money to return back to depositors at any single point of time. And that's also why there's always in history so many events of banking crisis. Take note again, this is not going to be the last banking crisis ever to happen in humankind. Banking is a confidence game. But having said that, as long as there's confidence, there's really no reason to pull monies out of the bank. You can't really put it under a mattress, correct? So money always needs to be stored in a place. And that could be a reason why also that right now, Bitcoin prices are rallying. It has actually rallied 38% over the last 3 weeks. Whether Bitcoin is a good alternative or not, that is a different story. But let's get back to the events happening at SVB. So the question is, why is there a need to raise capital, correct? It was to cover back losses. But why were there losses in the first place? And do other banks in US have losses also? What about Singapore banks? To answer that question, let's look at what SVB actually owns. You realize over here that the total assets of SVB has actually grown rapidly from 2019 all the way to 2021. I'll touch back on this again, so stay tuned. And if you look at the right hand pie chart, you realize that SVB's assets are mainly classified as held to maturity, which are predominantly long-dated US bonds like 10-year or 30-year US Treasury bonds, or available for sale asset, which are usually 1 to 5 years US government bonds. Only 35% of assets are loans, which goes to show this particular bank's biggest risk is in the performance of its available for sale asset and held to maturity assets, which are all US government bonds. While US government bonds are very safe in credit, the problem right now that was not forecasted was actually the rapid spike in bond yield, simply because Fed has been raising rates aggressively. Take note again, bond yields and bond prices are inversely correlated. And to explain the impact, let me pull up an ETF that actually tracks the 7 to 10 year US Treasury bond. From this chart, you can actually see that in 2022, the bond values lost about 19%. This goes to show how problematic the situation was. when people wanted their monies back, the bank can only sell what they own and take back 81 cents on every dollar that they've parked into US government bonds. And that's why losses started to mount. So the natural question is, besides SVB, what other banks in US, or is the US banking system on the brink of collapse? And to answer that, let me pull up this chart over here. You realize that on the left hand side are the biggest banks like JP Morgan and Bank of America. These are the more traditional banks which are supposedly more sound and have a lower percentage of cumulative assets. You would realize, however, that SVB is not the most extreme in terms of how they have ran their operations. There are at least 20 other banks in America, which are mainly the smaller regional banks, that also have a lot of assets in US Treasury bonds that require a mark-to-market loss. This can be found on FDIC. You will realize in the banking system, the cumulative unrealized losses for all these banks are in excess of $600 billion. So I think with that, the easy conclusion is to say that there's certainly going to be more regional banks in US that will go under distress. And if we were to take the guess a bit further, there will come a point whereby there is no rescue plan for the bank because it is just not an integral part of the system, and some of them might be left to fail. And with that, we can pivot to the next question. Are Singapore banks actually safe? To answer that question, let me pull up research by Phillip Securities. This is a comparison between SVB's ratio versus Singapore banks. The top column, percentage of assets in securities, we can see that SVB has more than 56% allocated in assets. And as we know, those assets are in long-dated US government bonds. On the other hand, our Singapore banks are not built up that way. You would realize that the percentage of assets are very, very low. Actually, come to think of it, if SVB did not commit all its capital towards long-dated US government bonds and simply kept all its money in money market funds, quite simply it could have averted this crisis. Because money markets mature very quickly, it's very easy to keep tabs with the rising interest rates. It's the long-dated bonds that have already been destroyed because holding to maturity is still 5, 10 or even 30 years away. We can guess that SVB actually committed to those assets to potentially earn a spread. Is that right or wrong? I think that's a debate for a future time. But we do need to ask this question. Why is there so much securities built up in its asset base? Why didn't SVB do a more traditional banking route of loaning out that money instead of going to do investments? That can be answered in this graph over here. This is a graph that shows the average deposit growth over the last 10 years. Over 10 years from 2011 to 2021. You would realize that SVB was taking in deposits way more than all other banking companies in US. The reason for that, SVB is Silicon Valley Bank, correct? And when interest rates were low, venture firms were raising monies left, right and center, and they were having a lot of deposits because tech was the darling boy. These venture firms and startup companies had a lot of monies that were deposited into SVB. The boom that was happening in tech actually fueled the boom that was actually happening in SVB. And the subsequent crash in tech that happened in 2021 and 2022 actually also impacted SVB. This graph shows that SVB's total deposits started to decay in 2022 simply because a lot of the startup firms had to start running on their cash reserves. So sentiment was bearish and it was difficult to raise new capital. Quoting again for Phillip Securities, SVB's assets actually grew at a compounded annual growth rate of 44% over 3 years. Due to the rise in venture capital funding during the pandemic, and many of SVB's customers became flush with cash. However, with the loan demand weakening, SVB actually channeled majority of these fresh deposits into securities portfolios or kept as cash. As interest rates started to rise in second half 2022, losses on securities started to appear. Singapore banks differ in this aspect. Assets and deposits grew over the last 3 years but at a much lower pace. With the rise in interest rates, Singapore banks were able to pass on higher funding costs directly to their customers as majority of their loans were on floating rate and the remaining fixed rate loans could be repriced. Let's pull back again the comparison table between SVB and Singapore banks and scrutinize on the loan to deposit ratio. SVB was focused on the tech sector that fueled its growth, but also when tech started to cool off, there was less demand for loans in that space. That's why the loan to deposit for SVB is only at 43%. Whereas Singapore banks, being more diversified across all sectors, have around 80% in terms of loan to deposit ratio. Not just that, from latest books, all three banks have registered loan growth, albeit at a slower pace. Singapore banks are just built differently. And if I were to quote from Maybank Securities, Singapore banks actually focus a lot more on larger corporates versus SVB, whose main clientele were startups. However, one area to be watching is second or third degree impact from Singapore Bank's exposure to private equity companies who may have startups that may be facing liquidity crunch. So far that's yet to surface, but in any case, being diversified in its banking approach will definitely mean that Singapore banks are way more stable and way more able to tolerate this downturn in the technology space. And as always, if you have learned something really, smash the like button and press on subscribe, especially like topics like this that covers on investment. Since you start with me to here, let me end things off with a big concluding point. Every hiking cycle over the last 70 years has ended in recession or a financial crisis. It is not going to be different this time. This is a quote by Morgan Stanley, which I'm pulling up again. And what I'll show you next is this graph over here that shows you the market performance after a recession. What we can learn is that every recession period is a time where valuations are actually cheap. And that means also that investing at that period will deliver strong returns. Could 2023 and 2024 be a good period to invest? And to answer the question on banking stocks specifically, I would like to pull up again the graph comparing SVB with Credit Suisse, DBS, and also probably Australia's largest bank to show you the different trajectories that each of these banks have experienced. SVB is the dark blue line over there. It spectacularly grew with the tech rally and crashed with it. Credit Suisse has been a decaying giant for the last 10 years. DBS, which is Singapore's biggest bank, and Commonwealth Bank of Australia, which is Australia's biggest bank, have exhibited slow and steady growth. They are in the light blue line and the orange line over there. Question to you is, if these banks are sound and you're a believer of their brand, does this correction actually present an opportunity for you or not? Leave in the comment sections what are your thoughts, and as always, smash the like button if you haven't done so. As always, if you like ideas on investments, especially this which covers on dividend investing, follow on next over here. With that, sign off. Thank you for watching. Goodbye.